Recording started.
Chapter 7, Job Costing. If you recall from the last chapter, we talked about three different costing methods. One was job costing, and that's when you have a company that produces more unique types of jobs or services, something like custom homes or movies. You also have process costing, and that's when your company creates homogeneous types of products like cornflakes, facial tissues, and paint, stuff like that. Those items are not individualized. They're very uniform. So you're not going to be able to account for each drop of paint or each cornflake separately. You're going to account for the entire process. And then also we had operation costing, and that was a type of a hybrid costing system, and that's used in manufacturing goods that have certain common characteristics like automobiles, computers, and clothing. Those have common characteristics, but also they have some individualized characteristics as well. So just as a refresher, those were the three types of costing systems that we talked about the last chapter. But this chapter we're going to focus on just one, and that's going to be job costing.
Recording started.
So first off, we need to explain what a job is. So a job in this chapter, we're not talking about employment or working for someone or a company, and that's your job. We're talking about a job as in, let's say you're a plumber, and then you're fixing a few different houses today, or an office building, something like that. Each of your customers is going to be a separate job. All right, so if you're producing services, each customer is a job. If you are producing something unique and individualized, and again we go back to the example of a custom home builder. Though each home that this custom builder builds is considered a separate job. All right, so it's a unit of a product that is easily distinguishable from other units. So again, when you are producing items that are individualized or providing services, your work is called jobs. That's how they're identified. So a job shop is just a business or a company that produces jobs. So a CPA firm for this chapter would be considered a job shop, because the services provided by a CPA firm to each client is going to be slightly different. The custom home builder that we talked about is going to be a job shop. So again, any firm that produces jobs, that's going to be known as a job shop.
Recording started.
So let's look at the example in the chapter. The example is a company called InShape Inc., and they manufacture custom workout and training equipment for schools and gyms. So the key here is that they are making custom equipment. All right, so they're not just making a bunch of the same stuff. Each school and each gym is going to want something different. So they are going to be considered the job shop. All right, and then in this example, the book tells us that InShape is beginning with 3 jobs, and they're going to call it 12-3, 1-1, and 1-2. All right, so these are the 3 jobs that this company is beginning with.
Recording started.
So the way that they're going to record direct materials is that what they do is the transfers out of raw materials inventory, they're considered direct materials, and then they go into the sub-accounts for 1203, 11, and 12. All right, so what you're probably used to seeing is you'll have, you might see a T account called direct materials. Okay, and then it's an asset account, so you're going to see debit. You should see amount on the debit side, because asset accounts have a natural debit balance. Now, when you have sub accounts, what it's going to look like is you're going to have accounts here for 12.3, for 1.1, and 1.2, and so these are going to go. These are going to have their own amounts, and what happens is when you add up these three, these three amounts in these sub accounts, they should add up to, or they should roll up into the main direct materials account. So depending on how the accountant decides to show it, it might just show the total for direct materials and then refer the reader to the three sub accounts, or the three sub accounts are going to have the amounts themselves, and the direct materials account doesn't have anything. Either way, you're going to be able to see clearly that the amounts that are in the sub accounts, when consolidated, should match up or equal what the direct materials main account should look like.
Recording started.
So going back to the previous slide, the direct materials, like I said, are going to be allocated into each job's sub-account. But then when you have indirect materials, as you know, the definition of an indirect material is these are materials that can't be directly tied to certain jobs. So then those get allocated into an overhead control account, and we're going to go over that more in a little bit.
Recording started.
Direct labor gets treated the same way. Direct labor is directly allocated into sub-accounts for each job to arrive at total work in process. But when you have indirect labor, that's going to be also recorded into the overhead control account, because again, indirect labor, just like indirect materials, cannot be directly traced to a job, hence the name indirect.
Recording started.
So once the indirect materials and indirect labor are allocated to the overhead accounts, then as we discussed in the prior chapter, we have something called the predetermined overhead rate. Alright, so that's the rate that we're going to use to allocate the overhead to the sub accounts. And so ultimately the overhead control account does get allocated to each sub account based on the predetermined overhead rate. All right, so the direct materials and direct labor, like I said, are directly allocated to those sub accounts since it's easily traceable. The overhead account, the indirect materials and indirect labor get allocated to the overhead account, but ultimately ends up in the sub accounts as well.
Recording started.
So going back to the example, it says that InShape Inc. has 3 inventory accounts. And remember, this is correct. A company that has that manufactures is going to have at least 3 inventory accounts. It's going to have direct materials, the work in process, and finished goods. In this case, it says that there are $30,000 in raw materials, $41,000 in work in process, and that's related to job 1203, and then $27,000 in finished goods inventory. So since we have amounts in finished goods inventory, that tells us that the goods are finished, of course, like the name of the account says, but they haven't been sent to the client yet. So since they haven't been sent to the client, they're still sitting on your books as inventory. So now we're going to look at activities that we had in January.
Recording started.
But before we continue, let's take a look at this data. So it says that direct materials inventory is 30,000. So you're going to see a T account for direct materials, and that's going to have 30,000 in it. All right, and remember, direct materials, work in process, and finished goods, those are all inventory accounts. And as we know, inventory is an asset. So you're going to put the 30,000 direct materials inventory on the left side of the T account. So that will be a $30,000 debit balance.
Recording started.
So the next slide says that we purchased $135,000 of raw materials. So we already had 30,000 on January 1st, and then we purchased another 135. So a purchase increases inventory, it's an asset. So at this point, if we wanted to see how much we had in materials inventory, we add up the two amounts, 135 and 30,000, so we get 165,000 in our materials inventory. But as you know, we do double entry accounting. So when you're purchasing something like raw materials on account, that means that you didn't pay cash for it. So that means that the journal entry is going to look like something like this. It'll show direct materials for 135K, and then you're going to have accounts payable. Remember, accounts payable, that's going to be a liability, and liabilities naturally have credit balances. And since this problem says that we bought the materials on account, that means we didn't pay cash for it. And so our journal entry is going to look like this: direct materials debited for 135K, and then credit accounts payable for 135K. So that means that when we draw our T accounts, the 135 to inventory goes on the debit side, and then accounts payable goes on the credit side, the right side.
Recording started.
The next entry or data says that the company used $12,000 of direct materials for job 1203, and then for jobs 101 and 102, they used $102,000 of materials and $15,000 of materials. So now we have to look at the journal entries again and the T accounts. All right, so if you add up 12 and 102 and 115, you get 129. Okay, so this tells us that we used $129,000 worth of materials. So what we're going to do is we're going to remove 129,000 from materials, and we're going to have to move it into work in process. And work in process Remember, that's the flow of things. You start when you buy materials, you put them in your direct materials inventory. I'm sorry, you put it in your materials inventory. Sometimes it's called raw materials. Then when you use it, you're going to put it into work in process, and then finally into finished goods. But the journal entry is going to look like that. Debit work in process 129K, and a credit materials in inventory for 129K. Now we do have to go one step further, because the work in process, we're going to split it into the 3 sub-accounts like we talked about. And so here the work in process sub-accounts, like I said, you're going to be able to see that they roll into the main account. Okay, so what does that mean? This 12,000 here, this 102 and 15, you add those up, and those are all debits, and they're going to match what we have here for work in process inventory, $129,000. All right, and then you can even see for a prior entry, we had $41,000 in work in process for the job 1203, and that matches the $41,000 in the main work in process inventory account. All right, so again, a sub account, all it is it breaks down the information in the main work in process inventory account, breaks it down into per job. But one good way to check it is to see that the debits and credits in the sub accounts add up to the debits and credits in the main account.
Recording started.
Right, next we look at direct labor. So InShape Inc. processed the time tickets for the workers, which were all direct labor. The total was 98,000. 16,000 of that was for job 1203. 71,000 was for job 101, and 11,000 was for job 102. So again, you can check this by adding up the 16 and the 71 and 11, and that will bring you to 98,000 total. All right, so that matches the direct labor amount that was given to us in the fact pattern. One thing to observe here is that work in process inventory, remember this is an asset account, right? And generally when we're talking about wages, in your prior classes you probably talked about when you're paying someone, you're going to credit cash for, let's say, $100, and then the debit is going to be something like wage expense, right? So it makes sense. You're paying someone the cash, or if you're not paying them cash, you're going to call it wages payable. Right? So cash or wages payable for 100, and then wage expense is going to be 100. All right, but the problem, or the difference in this problem is that you're not debiting wage expense, you're actually debiting an asset account. So that's one thing to notice here and to realize is that certain wages that you pay in at your company, certain people that you pay, they're going to be considered an expense. But then if you're a manufacturing company and you have people that are directly working on manufacturing, then that's actually required to capitalize their pay. And if you recall, we talked about capitalization before, and all that is when you decide that when you spend money, in this case we're talking about wages, so you're spending money on wages, is that wage an expense, or is it going to be capitalized, which means it's classified as an asset, And in this case, when we're talking about a manufacturer, the direct labor that goes into each job is going to be capitalized. So it's classified as an asset, and so that's why it goes into a work in process inventory, because work in process inventory is an asset.
Recording started.
Next, we take a look again at the manufacturing overhead. So we've talked about the predetermined overhead rate, and so if you recall, that rate is just an estimate to see what we or how much we allocate to each job. It's not going to be accurate because it's just an estimate, as we said. But we also have to keep track of what we do actually incur in overhead. All right, so remember, there's estimated overhead, and we have actual overhead. Now, at some point, we do have to reconcile the two, but in the beginning, we're gonna allocate overhead based on our predetermined overhead rate, and then we're also going to keep track of our actual overhead separately, and then get ready to reconcile the two at the end of the period. All right, so in this case, it looks like we had overhead of the $12,000 in indirect materials, $9,500 in indirect labor, $13,750 in utilities, and other factory expenses, $5,000 of prepaid expenses, and $11,200 of factory depreciation. So now we're going to have to record these expenses.
Recording started.
So all of these expenses are recorded as debits in the manufacturing overhead control account, and then they are put into other T accounts, the ones that were named on the prior slide. Let's see, so for materials inventory, it says that we requisitioned $12,000 of material, so that's why the materials inventory account is being credited. That means that we're removing $12,000 worth of materials out of the materials inventory account. Let's see, we had the utilities and other factory expenses, and it says the credit accounts payable, which we did there. Wages payable was credited as well. Accumulated depreciation was also credited, and then we also get to a prepaid expense. So if you recall, prepaid expense is actually not an expense. Prepaid expense is an asset account, right? Right. So usually prepaid expense is going to have a debit balance, but in this case, the prior slide said that we were using up prepaid factory expenses, right? It's the exact wording was prepaid factory expenses used for $5,000. So when you're using an asset account, then you credit that account to lower the balance. So so it's right to have the $5,000 as a credit on this slide. And then the way you can check is that you can make sure that the manufacturing overhead control account, all of the debits in this account are reflected under these other related accounts. So that's the way you cross-check that you did your correct allocations.
Recording started.
All right, the next topic is the predetermined rate, the predetermined overhead rate. And as the slide says, you are using estimated overhead Alright, and you're going to divide that by the estimated activity for the allocation base. So, again, a lot of these expenses haven't been incurred, which is why you're going to estimate the expenses. It says here that InShape uses estimates based on annual manufacturing overhead and annual production volume. And why does it do that? Because it does not want erratic or monthly costs or production volumes to affect the long-term production costs. So the cost accounting rules allow accountants to make estimates because of the matching principle. They don't want these taxpayers or their clients to wait until the end of the year to record their expenses, because then it'll be it'll show heavily on the last month, but it's more realistically incurred throughout the year. So cost accounting rules allow accountants to make these estimates, and the estimates are going to be a little bit off because, as I said, they're estimates, but we're going to reconcile those at the end as well.
Recording started.
So let's look at how InShape decides to allocate their overhead costs. Remember, there's many ways you can allocate it. You can allocate it based on direct labor cost. You can allocate it based on direct labor hours, or a variety of other bases, depending on what you think is the most accurate. All right. So in this case, it says that that they're going to use direct labor cost. So it's going to be a dollar amount. Right. We're not using hours. We're using dollars. And it says that they estimate that overhead is going to be $600,000 and direct labor cost is going to be $1.2 million. So now we have to look at what the predetermined overhead rate is going to be.
Recording started.
So as I mentioned before, the predetermined overhead rate is going to be simply the estimated overhead amount in dollars divided by the allocation base. And in this case, the allocation base is the $600,000 estimated overhead divided by the $1.2 million estimated direct labor costs. So then the rate is going to be 50 cents per direct labor hour, 50 cents or 50%.
Recording started.
So the way the company would allocate its estimated overhead costs, it takes its direct labor hours, multiplies it by 50 cents to the dollar, or 50%, and you get the overhead rate that is applied. Now again, keep in mind, the overhead rate that's applied does not necessarily equal actual overhead. Right, it's not the same thing. It can be at certain times, but 99.9% of the time, it's not going to be the same thing. Alright, so just be aware of how these amounts are calculated.
Recording started.
So this job shows that $8,000 is going to be applied to the job 1203, then $35,500 to job 101, and then $5,500 to job 102. So then you look at the key accounts, and it shows exactly what we just mentioned. It shows that the manufacturing overhead that was applied has your debit balances, and the reason for that is because they are moved into the work in process accounts for each job, and so you can check your work again. You can check to make sure that these numbers, besides the entries match up. What I mean by that is whenever you have whenever you have your manufacturing overhead applied account, you're gonna whenever you allocate it to the sub accounts, you're gonna remove it from that overhead account and then reclassify it as assets into your 3 sub accounts.
Recording started.
And the next part of the example, InShape Inc. Completed jobs of 1203 and 101. The jobs are then summarized and shows that job 1203 totals 77,000 and job 101 is 2085. All right, so it doesn't explain to us why job 101 is so much bigger than job 1203. Maybe a bigger school is ordering. That's probably what I think is a likely explanation. But the costs are allocated between the jobs and then totaled separately, so they're not going to be recombined for this purpose.
Recording started.
So once you finish the jobs, the materials and the labor and everything that you put towards the job was originally recorded and work in process, but ultimately they're going to be reallocated to the finished goods inventory. So the 77 and the 2085 in work in process, they just get transferred right over to the finished goods account.